Actually, when I inquired my student that what is the reason that why you have prepared the cash flow statement as per IND-AS 7, there is a very little story involved. I will just take 5 minutes time to narrate that story. See that Burnpur cement, which is in the region of Asansol, Raniganj region. Okay, now during Congress government tenure, what happened is that there was illegal assignment of limestone mines. Okay, now when the government changed, a new government came into the power, and they come the Supreme Court give their verdict that all the limestones which has been limestone mines which has been assigned to some uh, politically connected people, that will be completely stopped. As a result of that, what happened is that Burnpur cement was not getting a continuous supply of their raw materials. And this cash flow statement, you can see that this was discussed for the period 18-19. And as there was a deficit in the raw material supply, so as a result of that, there was a very low manufacturing. That means the number of units manufactured was very poor. And as a result of that, they suffered a huge loss. And as a result, what happened? That net worth of the company turned into negative. See that when the net worth is negative, which also means that negative working capital, which is a very serious situation. Now, when net worth is negative, remember that it is hampering the going concern concept of the accounting theory. Okay, there is some accounting is based on some theories, that is the going concern concept. That means we assume that the business will continue for unending period. We never assume that when a business starts, it will be stopped within 2 to 3 years. It is not a terminable venture. We assume that when a business is starting its business, it will continue for unending period. But when the net worth of the company is negative, then it hampers the going concern concept. And at that moment, the auditor asked the question that why not the company should be liquidated. That means when it is hampering the going concern concept due to this negative net worth, then the company must be liquidated. But in this case, what happened is that this company secretary prepared the cash flow statement and balance sheet and statement of profit and loss account, okay, as per Schedule 3 and as per the new accounting standard IND-AS 7. And he projected the future profitability of the organization. And by showing the future profitability, he tried to defend that the company is hampering the going concern concept. And as there is a possibility of making huge profit in the near future, in spite of the fact that it is hampering the going concern concept. But if you can show that the company's future is bright, it can earn huge profit in the future, which has been shown. That means on the basis of some future projects, that company secretary showed the auditors that yes, the company can earn huge profit. So that is why when they place this kind of things, when they put arguments against this, then the court that does not give any verdict that it should be liquidated. It was not liquidated and it is still continuing its business. Okay, this is just a story of cash flow statement. That means the voluntary preparation of cash flow statement as per IND-AS 7. Okay, but there are some circumstances. But I think within 1 or 2 years, we have to prepare the cash flow statement as per IND-AS 7. Now next, I'm coming to the fund flow statement, because there are some items which are very common in both fund flow and cash flow statement. I will highlight those items. Okay. Now the question is, try to understand that why we have to prepare the fund flow statement. We know that we prepare cash flow statement. Why? Because we want cash generating capacity of an enterprise. If you don't understand the cash generating capacity, then we cannot say that whether this company is a feasible organization, whether it is going to continue its business for the near future, whether it has any prospect or not. So the cash generating capacity or the cash position is reflected through the cash flow statement. The fund flow statement, why it is prepared? you know that at the end of the financial year, that means on 31st March of each and every year, we prepare profit and loss account and balance sheet. Okay, from profit and loss account, we can get the net results of financial operations. Net results means net profit. And from balance sheet, which is a statement and which gives us a picture of the financial condition of the business on a particular day, that is on the 31st March. So we can assess what is the financial condition of the business on 31st March. But it is very difficult to find out that whether there is any changes in the financial condition taking place from the last year to the current year on the basis of balance sheet. No. Balance sheet never tells us that whether the financial condition of the business is changing from the last year to current year or not. So for that purpose, that means if you want to assess whether the financial position or condition of the organization is changing from the previous year to the current year, you need to prepare another additional statement apart from cash flow statement, that is called fund flow statement. If you go through the annual report of many companies, you will find that there is no fund flow statement, but they internally prepare this fund flow statement because fund flow statement helps the companies to assess the changes in the financial condition. Not only that, the company can also assess its working capital position. Working capital means the capital which is required for day-to-day running of the business. Okay, so for that purpose, we prepare the fund flow statement. Now see that there is no standard format for fund flow statement. Okay, now in fund flow statement, you know that this is very important, that in fund flow statement there are three words: fund, flow and statement. Now this word fund is interpreted from three viewpoints. First, in general sense, fund simply means cash, that is the cash which is available in the hands of the company. So remember that when fund is interpreted as cash, we prepare cash flow statement. So on the basis of this interpretation that fund equals to cash, we prepare cash flow statement. Now the second one, when we interpret fund as the working capital, then we prepare the fund flow statement. That means fund flow statement is prepared on the basis of the concept that fund equals to working capital. Okay, and the modern concept, that is all the financial resources that have been employed in the business, is considered as fund. So remember that when fund equals to cash, we have to prepare the cash flow statement. When funds equals to working capital, we have to prepare the fund flow statement. Okay. Now next is what is the meaning of flow. Now in fund flow, there is inflows of funds and the outflows of funds. Remember that fund means working capital because I'm discussing fund flow statement. Now inflows and outflows of funds simply means inflows and outflows of working capital. Now let us try to understand this example, that whether there is an inflow of fund or outflow of fund. Now in this example, suppose the two accounts involved in the transaction belong to same category. Okay, what is the transaction? That is cash received from debtors is 20,000. So cash account debit 20,000, debtors account debit 20,000. Okay. Now see that in this transaction, both the accounts belong to the same category, that is current assets. Now see that cash is debited, that is current asset is increasing by 20,000, and debtors, that is also current asset, that is decreasing by 20,000. So see that there is no impact on the flow of funds because the same amount of current asset is inflowing in the business and the same amount of current asset is getting out of the business. So there is no impact on the flow of fund. But if the two accounts belong to two different categories, then there is either inflow or outflow of funds. For example, purchase of fixed assets. Then journal entry is fixed assets account debit to cash. So cash is a current asset and fixed assets is a non-current assets. So see that when a fixed asset is purchased, then cash, that is current asset, there is outflow of funds because there is outflow of funds. Similarly, when an asset is sold, then cash account debit to fixed assets. So there is inflow of funds. So inflow and outflow of funds takes place when the two accounts belong to two different categories. Okay. The next is the definition of fund flow statement. We know that this statement shows where from the funds of the working capital have been received and how these funds have been utilized. This statement explains the reasons for changes in working capital. That means this is a statement which shows inflows and outflows of funds, and it also explains that whether there is any change in the working capital or not. Okay. Now coming to this advantages of fund flow statement. On the basis of fund flow statement, we can do long-term financial planning. That means long-term financial planning means we can predict whether there will be sufficient inflows or outflows of funds if the company undertakes any expansion program. The company, if they want to survive, they have to undertake various kinds of expansion programs. They have to expand their business, but they have to predict whether the expansion program will bring sufficient inflows or outflows of funds or not. So that can be calculated on the basis of fund flow statement. And number two, I've already explained that on the basis of fund flow statement, we can easily assess the change in the finance position between two ends of an accounting period. That means whether there is any changes in the financial position from the last year to current year or not, that can be assessed on the basis of fund flow statement. And also we can assess the changes in the liquidity position. Liquidity means the short-term debt paying capacity of an enterprise. That can also be assessed on the basis of fund flow statement. Next, it highlights what? The fund generating capacity. Remember that from cash flow statement, we can assess the cash generating capacity, and from fund flow statement, we can assess the fund or the working capital, that is the generation capacity of the business. That is working capital generation capacity of the business can be assessed on the basis of fund flow statement. And another thing is that in future, various kinds of financial problems may arise. So that can also be noted down. That means projected fund flow statement can be useful in forecasting various financial problems. So if you prepare the fund flow statement, then it is very useful. That means it will forecast that your financial problems may arise after 2 years or 3 years. And depending on that, you have to take the necessary measures. And another thing is that if the bank or any financial organization wants to give any loan to any company, then they have to look into the fund flow statement. Okay, because the fund, on the basis of fund flow statement, banks and financial organizations can evaluate the credit worthiness of the firm. That means whether the company which is taking that loan, whether it is really capable of giving back that money or not, whether it can return the loan that it has taken or not. That means that is also reflected from the fund flow statement. Okay. Now coming to the how to prepare the fund flow statements, because I will discuss these things because this is a student's webinar, because they are going to solve some problems relating to fund flow statement, and I can assure you that definitely one problem will come from the fund flow statement, and there is no ambiguity about that. Now see that first step. In the first step, you have to prepare a statement of changes in working capital. Okay, that means first of all, you have to write all the current assets. You know that What is the difference between current assets and non-current assets? Current assets are those assets which can be easily converted into cash within a time frame of 1 year. And that 1 year is calculated from the closing of the last financial year. That means from 31st March 2020, within 1 year, that is 31st March 2021, or if the financial year is on 31st March 2021, that means within 1 year is 31st March 2022. So that means current assets are those assets which can be easily converted into cash within a time frame of 1 year. Okay. And after that, you have to see that as per this format. I think, so anyone, is it visible properly? Can somebody tell me that whether it is visible properly?
Yes, sir, visible.
Okay, okay, thank you. See that what are the items of current assets that you all know, that cash in hand, cash at bank, stock in trade, standard debtors, marketable securities, bills receivable, prepaid expenses, accrued incomes, advance tax paid, loans and advances. Next, current liabilities that you all know. So find out the total A and total B. Then you find out the difference between A and B. That will give you the working capital. And after that, you find out whether there is any increase or decrease in working capital or not. And see that, and in the right hand side, you have to also find out what is the effect on working capital. That means individual item wise, whether there is an increase or decrease. Okay. Now, this is the first step. That means if you are going to solve any problem relating to fund flow statement, then you have to prepare the working capital statement first. Okay. Now, next is in the step number 2. That means, remember that from the balance sheet, pick up the figures relating to current assets and current liabilities. You will be provided with the last 2 years balance sheet, and from that balance sheet, pick up the figures relating to current assets and current liabilities. And the remaining items which will remain in the balance sheet, those items are called non-current assets and non-current liabilities. That is, non-current assets is fixed assets and non-current liabilities like share capital, reserve, etc. Now, in step number 2, you have to analyze those non-current assets and non-current liabilities. And for analyzing those non-current assets and non-current liabilities, you have to open ledger accounts relating to each and every non-current assets and non-current liabilities. That means if there is any fixed assets, you have to open ledger account relating to that. If there is a land and building, you have to open ledger account relating to that. And if there is non-current liabilities like share capital, like equity share capital, you have to open ledger account relating to equity share capital. If there is securities premium, you have to open ledger account relating to securities premium. If there is general reserve, capital reserve, then you have to open ledger account relating to those each and every non-current assets and non-current liabilities for the purpose of analysis of non-current assets and non-current liabilities. This is step number 2. And in third step, you can see that we have to prepare the fund flow statement. It is nothing but, in the left hand side, we are showing the sources of funds, and in the right hand side, we are showing the applications of funds. You know that issue of share capital, it is a source of fund. Issue of debentures, it is a source of fund. Loans raised, it is a source of fund. Sale of fixed assets, sale of investment in the right hand side, that is redemption of preferential capital, redemption of debentures, buyback of equity shares. These are the applications of funds. Okay. And another thing I must tell you, that in step number 2, at the time of analyzing the non-current assets and non-current liabilities, you have to open one ledger account called adjusted profit and loss account. Okay. And another thing is that in current assets, there are 2 specific items. One is provision for taxation and another one is proposed dividend. Okay. These 2 items can be taken as current assets. If you treat these 2 items as current assets, then you have to incorporate those items under current assets. But if you don't treat these 2 items as current assets, then you have to treat it as non-current assets. And as per step 2, you have to open ledger accounts relating to provision for taxation and proposed dividend. And the recommended thing is that you don't treat provision for taxation and proposed dividend as current assets, but you treat this as non-current assets. That is recommended or advisable. But if you treat it as current asset, then there is no harm. There is no problem. It is well accepted. But generally, the recommendation is that don't treat this as current assets. You treat this as non-current assets. Okay. Now, coming to one problem, I will not discuss this problem. I just tell you that, see that you will provided with the problem. Okay. See that shareholders fund, non-current liabilities, current liabilities, assets, and everything is given. Just because I have taken this problem because keeping in mind that your exam, and I believe that in exam also this type of problem, more or less of this type of problem will come. So you can see that in this problem, dividend paid during the year is 75. The company sold part of the fixed assets for 24,000, whereas the WDV is 20,000. Depreciation charge on fixed assets during the year 1,40,000. So dividend paid is 75. Definitely it will be charged in the adjusted PL. The company sold the fixed assets for 24, whereas the written down value, that means after charging depreciation, the value is 20, but it was sold at a price of 24. That means there is a profit on sale of fixed assets. That will simply be credited in the adjusted PL account. And the depreciation, which is simply charged 1,40,000, that will be debited in the adjusted PL account. You know that we debit depreciation in the profit and loss account. In the same way, we have to debit the depreciation in the adjusted PL account. Next, investment costing 16,000 were sold during the year for 19,000. This one I'm discussing. That is the profit on sale of investment is 3,000. Interest on investment received 7,000 and credited to profit and loss. Interest accrued and paid during the year on bank loan 24,000. Okay, so interest accrued and paid, that means the company have taken a bank loan, and on that interest due and paid is 24. And income tax provided during the years 1,98,000. Remember that. Now, first of all, we have to prepare. See that first of all, though the problem is given in such a way that you can prepare the working capital. See that in the current assets part, we have taken inventory, trade receivables, cash, and cash equivalents. And remember that I have not taken that provision for taxation in the current assets. Current liabilities is trade payables, working capital. You can see that 3,04,000 and 3,42,000. So increase in working capital is 38,000. And individual item wise increase or decrease in working capital is also shown. That is also been carried. Okay. Just this is for all of you know how to prepare the working capital statement. Now, in the second step, we have to analyze the non-current assets and non-current liabilities. See that equity share capital. That means first of all, from the balance sheet, we have taken these items. We have taken which items? We have taken this inventory. We have taken trade receivables. We have taken cash and cash equivalents, and we have taken trade payables from the balance sheet. So the remaining items are non-current assets and non-current liabilities. Now in the step 2, we have to analyze this non-current assets and non-current liabilities. See, given and closing is given, the difference is issue of further equity share capital. Securities premium, that means the additional money raised at the time of issuing equity shares. See that opening is 1 lakh, closing is 1,20,000. The difference is the further money collected by issuing premium. General reserve, the opening is 3,60,000, closing is 4,40,000. That means from the current year, we have set aside 80,000 from profit and loss account. Now coming to this provision for tax. See that in the balance sheet, you can see that provision for tax, that is the opening is 2 lakh and the closing is 2,10,000. That is provision for tax. And remember that the same rule is applicable for provision for taxation and proposed dividend. Okay. See that provision for tax, the opening balance is 2 lakh, closing balance is 2 lakh 10,000. Okay. And remember that here it has been mentioned that income tax provided during the year 1,98,000. 1,98,000. I think there is a income tax provided that will be, it is written 1,88,000. There's a slight mistake. This will be 1,88,000. Okay. So that means you can see that it has been specified in the problem that income tax paid in the current year is 1,88,000. So see that this is the opening balance, this is the closing balance, and the amount of tax paid in the current year is what? Is 1 lakh. No, it is fine. That is, you can see that income tax provided during the year is 1,98,000, and that is charged in the adjusted profit and loss account. Okay. So 1,89,000 is the income tax provided in the current year. That means the income tax which is provided in the current year, it is to be in the adjusted profit and loss account. So 2 lakh plus 1,98,000, that is 3,98,000. 3,98,000 minus 2,10,000, it will give you the balancing figure of 1,88,000. That is tax paid is 1,88,000. So again, I'm repeating, this is a very, very important, is that don't treat provision for taxation and proposed dividend as current assets. My advice is that you treat the provision for tax and proposed dividend as non-current assets and open ledger accounts relating to provision for tax and proposed dividend. So there is no item of proposed dividend in this current problem. So there is provision for tax. So opening and closing balance is given. The current year income tax provided is 1,98,000, which is given. So that income tax provided is charged in the adjusted profit and loss account. So the balancing figure is the income tax paid. But remember one thing, that if nothing has been mentioned in the adjustment, suppose nothing has been mentioned, like there is nothing has been mentioned, income tax provided during the year, nothing has been mentioned, then what is to be done in that case? That is 1,98,000 is not mentioned. This is very, very important. That is, opening is given 2 lakhs, closing is given 2,10,000. Okay. Now the opening is what? This is the opening provision for tax. Opening provision for tax means last year. That means what? The company calculates its tax on the basis of self-assessment. That means they estimate their tax liability. That means in the last year, they have estimated their tax liability. And on the basis of that, they have set aside some amount from the profit and loss account in the name provision for tax. That means on the basis of self-assessment, they have calculated their tax liability, more or less, that will be correct. That is the estimated tax liability, and based on that estimated tax liability, they have set aside some money from the profit and loss account. That was done in the last year, and that becomes the opening balance in the current year. Okay. And the closing balance in the provision for tax is 2,10,000. And nothing has been mentioned that what amount of tax is paid in the current year or what amount of tax is provided in the current year. So in that case, the last year's provision, that is 2 lakh rupees, is to be paid fully in the current year. I think all of you have understood. That means opening balance of provision for tax, if nothing has been mentioned, then the opening balance of provision for tax is to be paid in the current year. In that means to bank account tax paid, it will be 2 lakh. And in the current year, we have to make a provision for tax which is equal to the closing balance of the provision for tax account. So that means by adjusted profit and loss account, it will be 2,10,000. It will be 2,10,000. Okay. So I think all of us have understood it. That means if nothing has been mentioned regarding the payment of tax or the current year's income tax provided, then in that case, last year's provision for tax is to be paid fully in the current year. That means 2 bank will be 2 lakhs. And in the current year, we have to set aside some fund from the profit and loss account, which is equal to the closing balance of provision for tax. So by adjusted profit and loss account, that will be 2,10,000. That means this treatment will be done when nothing has been mentioned regarding the amount of tax paid or the tax provided during the current year. Okay. So see that non-current investments, this is very simple, opening and closing. There is a profit on sale of investment, and the difference is coming as a purchase of further investment. In this side, this is sale of investment that is given, and this is purchase of investment. Okay. Now the fixed assets account opening, closing, sale is 24. There is a profit on sale of 4,000. Depreciation, I told you, by adjusted profit and loss account, and bank is purchase of fixed asset, that is the balancing figure. Bank loan opening 4,20,000, closing 4,60,000. So the loan taking, further loan taken is 40,000. Okay. Now there's a ledger posting in the adjusted PL account. So we have posted all the items from all the ledger accounts. Okay. And see that another thing is that you can see that one item which is coming as a balancing figure, which is called fund from operations. So from adjusted profit and loss account, you will get fund from operation. That means fund means working capital. That means due to the operation of the business enterprise. That means what is the operation of the business enterprise? That means the purchase, sales, collection from debtors, payment to debtors, payment of royalty. These are the operating activities of the business. So due to these operating activities, the company have been able to generate a fund to the extent of 5,79,000. So that means working capital generated due to the operation of the business enterprise is 5,79,000. Now after that, we have to finally prepare this fund flow statement. You see that in case of these ledger accounts, in some ledger accounts, you will see that there is by bank. It will be written in the source, and in some, see that this is by bank. So this will be written in the source, and in some ledger account, this is written to bank. That means this will be written in the application side. So from the ledger accounts, you try to find out by bank and to bank. So by bank will come in the source side, and to bank will go in the application side. Okay. So in this way, issue of equity shares at a premium of 20, sale of investment, loan taken, fund from operation. Fund from operation is a source of fund. Sale of fixed assets, interest on investment, payment of tax, purchase of investment, purchase of fixed assets, and increase in working capital. If there is an increase in working capital, it means application of funds. And if there is a decrease in working capital, it means source of funds. Okay. Now, I think a lot of students are confused that how this increase. If I ask you, can someone tell me that why this increase in working capital is a source of fund, and why the decrease in capital is a source of fund? Increase in working capital is a application of funds, and decrease in working capital is a source of fund. Okay. I think only few students can answer that question, but I can answer you in this way. I think I need to open the paint, just a minute. I think this window is visible. Is it visible?
No, sir.
Now is this visible?
Yes, sir. Visible.
Yes,
Yes, sir.
okay. See that this is very, very important. Okay. See that what is working capital? Working capital is current assets minus current liabilities. That you all know. But you have no answer to this item, that increase in working capital means application, and decrease in working capital means is a source of fund. So working capital is what? Current assets minus current liabilities. Suppose the current liability is 0. Current liability I'm assuming it is 0. Okay, so what is working capital equals to current assets? Clear? Working capital equals to current assets. Okay, that means if current asset increases, working capital increases. If current asset decreases, working capital decreases. Now, take any one item of current assets. That is, suppose I'm taking only one item because this is stock. Okay, stock. Stock. Suppose stock is decreasing. Stock is decreasing means working capital is also decreasing. Can anybody tell me that what is the meaning of stock in decreasing? Stock means what? Whether it is inflow of funds or outflow of funds. Somebody tell me this, please, anyone. If the stock is decreasing, is it inflow of funds or outflow of funds? Please interact with me. Anyone, any student is there, I think? Anyone? If stock is decreasing, then it means inflow of funds. That means suppose at the beginning of the year you have a stock of 50,000 and at the end of the year you have a stock of 10,000. That means you have liquidated stock to the extent of 40,000. That means there is a sale of 40,000. That means you have sold goods for 40,000. 40,000 worth of goods have been sold. That means you have collected money by selling 40,000 worth of goods. That is what? That is inflow of funds. Okay. So when current asset is decreasing, that means working capital is decreasing. It means inflow of funds. Okay. The reverse is also true. Stock is decreasing means what? Working capital is decreasing. Now stock is decreasing means what? It is inflow of funds, nothing else. It is inflow of funds. So that is why it will be written in the left hand side of the working capital statement. That is the fund flow statement. That is in the source side, we have to write that decrease in working capital is a source of fund. Okay. And when the stock is increasing, that means the company is unable to sell the stock. The stock is piling up. Stock increasing means working capital is increasing. That is the money is getting blocked. Okay, that is treated as outflow of funds. Why outflow of funds? Because your stock is piled up, and for manufacturing that stock you have to purchase raw materials, you have to incur labor expenses, you have to incur direct and indirect expenses that you've already paid for. So that is application of funds. So stock increasing, that means piling up of stock, means working capital is increasing. It means outflow of funds. Okay, when the stock is decreasing, it means that means liquidation of stock. So inflow of funds. Stock is decreasing means working capital is decreasing. That is why it is written in the source side of the fund flow statement. I think you have understood it. Okay. So now next, again I'm coming to my original presentation. That is this. Now there are some typical items in the fund flow statement, though I've already discussed this. That is provision for taxation. I've already discussed. You can see that is the opening provision and closing provision will be given in your balance sheet. The actual payment of tax, if it is not given, then the last year's provision, if this is 10,000, then here you have to write 10,000. And in the current year, you have to make a provision. If suppose this is 20,000, then you have to write it 20,000. Okay. If the opening provision is 10,000, then in the current year, you have to pay the last year's provision of 10,000. And if the closing balance is 20,000, then you have to make a provision for 20,000 by setting aside the amount from the adjusted profit and loss account. That is called provision for taxation. So see that when we are treating the provision for taxation as non-current assets, then in that case, actual payment of tax is to be shown in the fund flow statement. But if the provision for taxation is treated as a current asset, then in that case, the actual payment of tax is not to be shown in the fund flow statement. Again, I'm repeating that if you treat provision for taxation as current assets in the working capital statement, then in that case, actual payment of tax will not be shown in the fund flow statement. But if you treat it as non-current assets, then in that case, the actual payment of tax is to be shown as an application of funds. And the second method is better and logically acceptable. Unclaimed dividend, see that what kind of adjustment you have to done. That is where it appears in both last year's balance sheet and the current year's balance sheet, then it should be treated as current liability. But if it appears only in the current year's balance sheet, then it should be adjusted in the proposed dividend account. Okay. Interim dividend, when declared, profit and loss debit to interim dividend. When paid, interim dividend to bank, the amount should be shown on the debit side of adjusted PL, and it should be shown in the application side of the fund flow statement. Next, this is very, very important for your exam point of view. This item, that is dividend received on investment. There may be pre-acquisition dividend or post-acquisition dividend. So it will be clear if you consider this example. See that you have purchased the shares of XYZ Limited in the month of April 2021. If you purchase the shares of XYZ Limited April 2021, are you eligible for dividend for the financial year 2021? Yes, you are eligible for the dividend 2021. How is it possible? Sir, I have purchased the shares on 1st April 2021. How I am eligible to get dividend for the year 2021? Yes, I am eligible to get that because the shareholders register remains open for few days in the month of April. Maybe up to 10th April, the shareholders register remains open. Then in that case, if I purchase the shares of XYZ Limited during any time period between 1st April to 10th April, then I will be considered as a shareholder and I will be eligible for the dividend for the year 2020-21. And this is the pre-acquisition dividend. And after purchasing the shares, the dividend which is declared out of the current year's profit, I'm also eligible for that. That will be the post-acquisition dividend. So pre-acquisition dividend is actually reducing the cost of investment. That means if I've invested 10,000 rupees in purchasing shares of XYZ Limited, and if I have received 2,000 rupees as pre-acquisition dividend, that means the dividend for the period during which I was not a shareholder of that company. I was the shareholder only because I have purchased the share during that time period during which the shareholders register remains open, and as a result of which I become the shareholder for the financial year 2021 and becomes eligible for the dividend. So 10,000 is my original investment, 2,000 is windfall gain. That means the dividend for the pre-acquisition period. So what is my net investment? The net investment is 8,000. That is my net investment. Okay. So see that when the dividend is received, bank to dividend received, and when the dividend is transferred, dividend received to profit and loss, that is the post-acquisition dividend, that is the current year's dividend will be credited in the PL account. But pre-acquisition dividend, it is simply recovery of my investment. It reduces the cost of investment. So I've invested 10,000, 2,000 is pre-acquisition dividend. So 2,000 will be credited in the investment account. So dividend received should be shown as a source of fund. Post-acquisition dividend should be shown on the credit side of profit and loss account. And if there is any pre-acquisition dividend, that should be shown on the credit side of investment account. So this is the investment account, opening and closing balance by bank account sale of investment to bank account purchase of investment to dividend account, that is the pre-acquisition investment. Okay, so you have to open investment account whenever there is pre-acquisition and post-acquisition dividend. And there are some non-cash transactions. There may be, for example, assets purchased by issuing shares. So there is no monetary, there is no money involvement in this transaction. The company is purchasing assets, and against that they are issuing shares. So asset account debit to share capital, and simply this type of transaction may be ignored, and issue of shares should be considered as a source of fund, and purchase of assets should be considered as an application of fund. Okay. Now time is very short. I'm coming to this cash flow statement. I think it is visible. Now see that in cash flow statement, there are cash arising or cash movements in cash flow statement takes place due to three types of activities. One is called cash flows from operating activities, cash flows from financing activities, and cash flows from investing activities. Okay. Now, what is operating activities? I've already explained you that operating activities means that purchase, sales, payment of commission, payment of royalties, fees. That means the activities which are part and parcel of day-to-day activities of the business. That is called operating activities. Purchase and sales. These are the day-to-day activities. So cash flows from operating activities, that is the cash which is generated due to the operating activities, will be categorized under cash flows from operating activities. Now coming to cash flows from investing activities. Investing activities means if the company purchases any fixed assets, then that means if the company purchases any fixed assets, then purchasing fixed assets is investing activity, and as a result of this activity there will be outflow of cash. If the company sells any assets, fixed assets, then there will be inflow of cash. So purchase and sale of fixed assets, these are called investing activities. Okay. Now next is cash flows from financing activities like issue of shares, issue of debentures, issue of preference shares, that which changes the composition of the owner's capital. That means if the company issues further share capital, equity share capital, it changes the composition of owner's capital. That means there will be more number of owners in the company. If the company further issues debentures, or if the company borrows money by issuing preference shares, these are called financing activities. There may be redemption of debentures, there may be redemption of preference shares, there may be redemption of loan, repayment of loan. These are all coming under the financing activities, and cash inflows or outflows due to the financing activities is to be classified under the cash flows from financing activities. So in cash flow statement, we have to consider the inflows and outflows of cash taking place due to these three types of activities. Okay. Now, how to calculate these operating cash flows, financing cash flows, and investing cash flows? Now see that there are basically two methods. One is direct method and indirect method. In direct method, we are not going to follow that, and no one is going to follow the direct method. But indirect method, this is we have to follow. Okay. So indirect method, first of all, it is similar to the fund flow statement. Again, I'm repeating, it is similar to the fund flow statement. It means that first of all, you have to, in fund flow statement, you have to prepare working capital statement. But in this case, you're not required to prepare the fund flow statement. In the second step, you have to analyze the non-current assets and non-current liabilities. So here we are starting from step 2 of fund flow statement. That means first of all, from the balance sheet, you pick up the non-current assets and non-current liabilities, open ledger accounts relating to this, and analyze the non-current assets and non-current liabilities. The remaining items are called current assets and current liabilities. Those current assets and current liabilities will be dealt in this operating cash flow, investing cash flow, and financing cash flow. Though there are some fixed assets purchase that will be reflected from the ledger accounts. Okay. Now see that in this operating cash flow, there is one concept called cash and cash equivalent concept is applicable. But this equivalence concept is not applicable for investing activities and financing activities. That means cash and cash equivalence means that is the accrual basis of accounting. That is the accrual basis of accounting. That means due but not yet received, due but not yet paid. This concept is applicable only in the operating cash flow part. But in the investing and financing cash flow, the actual concept or the cash equivalence concept is not applicable. So see that first of all, we have to prepare the ledger accounts relating to non-current assets and non-current liabilities. And along with that, in the first part, we have to open one adjusted profit and loss account. If you open the adjusted profit and loss account, from that part, you will get the fund from operation. I can show you one solution here that you can see that first of all, I have to open this ledger accounts, fixed assets, equity share capital, debentures, etc. And you can see I've also opened the adjusted PL account. From that, we are getting this fund from operation. And this is the starting point for preparing the operating cash flow. Fund from operation, see that here the fund means cash. And in the fund flow statement, we have interpreted fund as working capital. So 3,45,000, this is the starting point for preparing the operating cash flow. So see that in this case, that this is operating profit or fund from operation as per adjusted PL account. This is the 3,45,000. This is the 3,45,000 that I have shown you. This is the 3,45,000, and this is the starting point of this operating cash flow. Okay, this is 3,45,000. So that means due to the operation of the business enterprise, the enterprise have been able to generate this amount of cash due to the operations of the business enterprise. 3,45,000 is the cash generated by the business due to the operation of the business enterprise. And with this figure, we have to add inflows of cash. And from this figure, we have to deduct the outflows of cash. Now, what are the items of inflows of cash? First of all, here I have written it very specifically. You can see the decrease in non-cash current assets. You take any current assets that is non-cash, other than cash. That is debtors. Debtors is decreasing. What does it indicate? It indicates that you have received some money or some cash from your debtors. So that is inflow of cash. So that should be added. Decrease in debtors is inflow of cash because you are receiving money from the debtors. Okay. And if the debtors balance is increasing, that indicates outflows of cash. Suppose at the beginning of the year, the debtors balance is 10,000, and at the end of the year, the debtors balance is 50,000. That means you have sold goods to credit, you've sold goods to debtors to the extent of 40,000 on credit terms, and they're going to make the payment after 3 months. 10,000 is the initial balance, 40,000 is the closing, 50,000 is the closing balance at the end of the year. So 40,000 is the further. There is no actual outflow of cash. Okay. Okay. But on the basis of cash equivalence concept, you have to treat it as outflows of cash. So when the debtors is decreasing, that is when the non-cash current asset is decreasing, it means inflows of cash. And when non-cash assets are increasing, it means outflows of cash. Similarly, when current liability is increasing, suppose the creditors balance is 50,000 to 90,000. That means what? The company have purchased further goods on credit terms to the extent of 40,000. So 50,000 to 90,000. So why this is treated as inflows of cash? Because we are applying the actual concept of the cash equivalence concept. That means that on the date on which we are preparing the cash flow statement, on that date we are not required to make the payment of 40,000. The payment will be made after that. So on the date on which we are preparing this cash flow statement, on that date, as we are not making the payment of that 40,000, that is why it is indirectly improving our cash position to the extent of 40,000 on the basis of cash equivalence concept. That is why it is added. Similarly, when the current liability is decreasing, that means suppose from 70,000 to 50,000, that means the creditor balance is decreasing from 70 to 50. That means what? Payment made to the creditors. That is outflow of cash. So when the current liability is decreasing, it means outflow of cash. And when the current liability is increasing, it is treated as inflow of cash, though there is no actual any inflow of cash, but on the basis of cash equivalent concept, the cash position is improved to that extent. Next, payment of tax. Okay, you'll get this figure. interest on debt capital and dividend on preference capital. See that here in the operating cash flow part, we are applying the cash equivalence concept. Now, interest on debt capital, that means what? Suppose the company have issued debentures to the extent of 1 lakh rupees. So 10% interest means 10,000 is the interest due, but on the date on which we are preparing this cash flow statement, on that date, that 10,000 interest payment will not be paid. So as a result, your cash position is improving to the extent of 10,000. So that is why you are adding that interest on debt capital. That is, the interest on debt capital is due but not yet paid. So that is why it is improving your cash position to the extent of that. Similarly, if any dividend is due on preference capital, which is due but not yet paid, then that should also be added, because that is also improving your cash position. So in this way, finally, you are getting the operating cash flow. Next, you have to prepare the investing activities and investing cash flow. That is cash sales from non-current assets. And remember that in ICF and FCF, you have to apply the cash approach. Cash approach means whatever cash is received and whatever cash is paid, that is to be accounted for in this part. There is no question of accrual concept in investing cash flow and financing cash flow. See that sale of non-current assets is fixed assets, purchase of fixed assets and investment is outflow, that is why it is deducted. And if you receive any dividend, that means if you have invested shares in other companies, you will receive dividend, that should be added. If you have invested somewhere and if you have received any interest, that should also be added. And after that, you will get the investing cash flow. Financing activities and financing cash flow, that is issue of shares, issue of debentures, long-term loan. These are the inflows of cash, redemption of preference capital, redemption of debentures, repayment of loan. All these are outflows of cash. Less dividend paid, including preference dividend, and if any interest is paid, that should also be deducted, and that will finally give you the financing cash flow. Now, finally, you have to do the cash flow statement as per accounting standard 3. See that in your balance sheet, the last 2 years cash and cash equivalents, cash balance will be given. That is, starting with the last year's cash balance, you add your operating cash flow that you have calculated above, investing cash flow and financing cash flow. And if it is matching with the closing cash and bank balance which is given in your balance sheet, you start with the opening cash and bank balance which is given in your balance sheet and add the operating cash flow, investing cash flow and financing cash flow. If it is matching with the closing cash and bank balance, that means your answer is correct. Even if it is not matching, that means there is something definitely wrong and you have to rectify it, and you have to finally match it with the closing cash and bank balance. I've taken one example which is more or less similar to this fund flow statement. I'm just showing you that what first of all you have to open the ledger accounts, and the same principle is applied, that is by bank to bank, etc. Equity share capital, debentures, and this part you can see that fund from operation as per adjusted profit and loss account, that is 3,45,000. You can see that as per my format, the stock figure is decreasing, that is inflow of cash. Increase in current liability, there is no such figure. Increase in non-cash current assets, that is here you can see that the debtor is increasing, that is treated as outflow of cash. Current liability is increasing, current liability is decreasing, that means there is payment to creditors, this is called cash from operation. Payment of tax, there is no figure, so 2,45,000. Interest on debentures, that is, see that what is the amount due on interest on debentures. See that you go to the debentures account, opening is 6 lakh, closing is 5 lakh. Okay, so that means there is a redemption of 1 lakh debentures along with a premium of 10,000. So 1,10,000. So as per the nominal value and face value, 6 lakh is the opening, closing is the 5 lakh. So in the current year, the company have to pay interest on debentures on 5 lakh rupees, that is 50,000. And this amount is due but not yet paid, because we are applying the cash equivalence concept or the accrual basis of accounting in the operating cash flow. That is why this interest on debentures, that is 50,000, is added. that is 2,95,000. Next, we have prepared the investing cash flow, that is purchase, a sale of fixed assets, purchase of fixed assets, and it is giving us the negative investing cash flow. Financing cash flow, issue of equity shares, that the figure you will get from this equity share capital account. Redemption of debentures, interest paid, dividend paid, that will give you the financing cash flow. Next, opening cash and bank balance, that is with that it is given in your balance sheet. See that in your balance sheet, what is the opening cash and bank balance, it is given. See, cash is given 1 lakh, closing is given 2 lakhs. Okay, so this is the opening. See that opening cash and bank balance is 1 lakh. OCF, ICF, and FCF is calculated. So adding this 1 lakh, it is perfectly matching with the closing cash and bank balance. That means your solution is correct. Okay. Now next topic, that is the ratio analysis, that is for financial statement analysis. Okay, so in the ratio analysis, why we do the ratio analysis? See, that ratio analysis is done. That means you know that in the profit and loss account in the balance sheet, there are a large number of figures in there. And we need to find out what kind of relationship exists between the two figures of profit and loss account and balance sheet. We need to interpret them. That means preparing this profit and loss account and balance sheet is not sufficient. We need to interpret the figures of profit and loss account and the balance sheet, and for that purpose we need to calculate the ratios, and it helps us to measure the liquidity, solvency, profitability, and management efficiency of the firm. See that ratios can be presented in three forms: in the quotient-like form, like 2:1, which is called current ratio; in percentage terms, like gross profit ratio 20%; in terms of times, like stock turnover ratio 6 times. Now, coming to this, I will discuss only few ratios because there are a large number of ratios. But considering your exam, only I will discuss only few ratios. I think shall I continue for another 10 minutes? Hello. Shall I continue for another 10 minutes? 10 or 15 minutes?
Yes, sir.
Okay. Okay, see that classification on the basis of financial statements. Okay, first is the revenue statement ratios. Revenue statement means that is the profit and loss account. So on the basis of profit and loss account, the three important ratios are gross profit ratio, net profit ratio, and operating ratio. Now on the basis of balance sheet, these two ratios are highly important from your exam point of view. That is why I've taken these two ratios only: current ratio and debt equity ratio, mixed or composite ratio, that is stock turnover ratio, debtors turnover ratio, and return on capital employed. Okay, now classification on the basis of functions. Now on the basis of functions, accounting ratios can be classified on the basis of what? Profitability ratio. This is very important. See that gross profit ratio is what? Gross profit by sales into 100, and there is no standard for gross profit ratio. Generally, a gross profit ratio in the range of 25% to 30% is considered as standard for all industries. So as per your calculation, if your gross profit ratio is coming 28 or 27 or 26, then you can see that gross profit ratio is satisfactory. Now, significance and interpretation. See that a high gross profit ratio, higher than the industry average, indicates that the firm is able to produce goods at a relatively lower cost. High gross profit ratio, higher than industry average, it means that it is manufacturing goods at a very lower cost. And the low gross profit ratio indicates that it is manufacturing goods at a very higher price. And it also indicates what? It indicates weak profitability and managerial inefficiency. There's a slight mistake: managerial inefficiency. Net profit ratio, that is net profit by sales into 100. In this case also there is no standard, and the ratio shows that how much per rupee of sales remains left for the owner after meeting production and other costs. That means, suppose the sales, out of that, suppose your expenses is coming 7, so the remaining 3 rupees is your net profit. That is the net profit ratio will be calculated on the basis of 3 rupees. Okay. So that means how much rupee remains after from sales if you deduct your production and other cost, and a high net profit ratio, sorry, a high gross profit ratio but low net profit ratio indicates that the firm has excessive indirect expenses on which it has no control. Sometimes a situation arises while solving a problem you may face that the company is having a high gross profit ratio but a low net profit ratio. It indicates what? It is having excessive indirect expenses on which it has no control. Next, return on capital employed or return on investment. And in the numerator part, we have to take in return on net profit or EBIT divided by capital employed into 100. Standard, generally there is no standard and it depends on industry standard. Significance, the ratio indicates what? It indicates how much return the company has earned per rupee of capital employed in the business. Suppose the ratio is 20%. It means if the company have invested 100 rupees, then they have got a return of 20 rupees. Okay. And a higher ROC, return on capital employed, or return on investment indicates high profitability and sound managerial efficiency. And a lower return on capital employed or return on investment compared to industry standard show that the firm is not at all able to earn reasonable profit on capital employed. And it also reveals inability of the management to increase the profitability of the firm. That means the return on investment is poor. That means it is not at all able to return its, that means it is unable to generate sufficient profit by investing money. Liquidity ratios, this is important for your exam point of view, that is current ratio or the working capital ratio, and it indicates the short-term solvency, that is the short-term debt repaying capacity, that if the company takes loan, whether the company is able to return that loan or not, that can be calculated on the basis of current ratio, that can be interpreted on the basis of current ratio or the working capital ratio. The standard is, remember, that 2:1, that is per 1 rupee of current liabilities, current assets of rupee 2, that is current assets 2 means current liability should be 1. It is considered as ideal. Current ratio is current assets by current liabilities. See that a higher current ratio does not always indicate a sound debt paying capacity. If your current ratio is very high, that does not mean that if you take the loan that you will be able to repay that. Why the ratio is high? Because the current assets includes obsolete stock. The figure is very high, but it includes stock. Current assets, stock is one item of current asset. It includes very obsolete stock. Debtors, huge debtors, but slow paying debtors or outstanding debtors. As a result of that, your current ratio is very high, but actually it does not indicate that you are able to actually return the money. On the other hand, low current ratio, then ideal does not always speak of low debt repaying capacity, because it may happen that the current assets include high quality stock and well paying debtors. Liquid ratio or quick ratio, that is current assets minus stock plus prepaid expenses divided by current liabilities minus bank overdraft. Standard is 1:1. And the time is very short. Stock turnover ratio, cost of goods sold by average stock. Standard is absent, and the average stock turnover of the industry is followed as ideal norm. And next, coming to this debt equity ratio, that is the external debt of fund divided by proprietor's fund or owner's equity. External debt includes long-term debt plus short-term debt, and here the standard is 1:1. Some people say that 1:2, that is the proprietor's fund should be twice the external fund, but the standard is 1:1. That is the comfortable ranges if both of them are equal. Okay, and remember that a high debt equity ratio indicates greater dependence of the firm on the external fund. That means you are more dependent on the borrowed funds. That is not a good sign. And it also indicates that the firm is exposed to greater financial risk. That means if you are borrowing more money by issuing debentures, then you are exposed to more financial risk and more external interference in the management. Now next is proprietary ratio, proprietor or shareholders fund divided by total assets minus fictitious assets. And capital gearing ratio, fixed interest bearing capital divided by equity share capital plus reserve and surplus. And standard, it depends on the nature of the firm. And capital gearing ratio greater than 1, that means highly geared firm. That means there is more dependence on debt and preference capital. And next one is, that should be a typing error. That is, if it is equals to 1, that means both of them are equal. And if it is less than 1, that means there is less dependence on debt and preference capital. Fixed assets proprietorship ratio is fixed assets by proprietor's fund Revenue statement ratio, that is operating ratio, cost of goods sold plus operating expenses divided by net sales. It is standard is absent. Remember that operating ratio, it is very, very important. Generally, it is accepted in the range of 70% to 80%. Okay, a low operating ratio indicates that the firm has more surplus fund after meeting operating cost. The surplus can be used for payment of tax, payment of dividend, transfer to reserve, etc. So a higher level of operating ratio is preferable for all companies. Debtors or receivables turnover, that you know if it is expressed in times credit sales by average debtors or average receivables, if expressed in months, average debtors or average receivables divided by credit sales. And you can see the standard is absent and the average industry standard is followed as an ideal. See that the compared to industry standard, a high debtors turnover reveals quick collection from debtors. That means if the ratio is very high, then it indicates that the money is very collected. Money is collected from the debtors at a very fast rate, which indicates a very good sign. Now, these are the problems. Just in problem, you have seen that current and quick ratios are above the ideal standard and hence they are satisfactory. Debt equity ratio is much below the ideal standard. Profitability ratios are not too good. You can see that the gross profit ratio is 14, net profit ratio is 6.7. So these two ratios are not good. Okay, and debt equity ratio is 0.7 is to 1. So you can see debt equity ratio is much below the ideal standard of 1 is to 2. So it is a good sign. This is another problem which I want to discuss. Just touching upon just the holding company part. That the things that I think there is time is not almost 45. So whole definition of holding in subsidiary company. You have to understand the accounting standard 110 IND-AS, that is the current accounting standard, because in holding company you have to prepare the consolidated financial statement as per accounting standard 21 and current accounting standard is 110, but we have to follow accounting standard 21. And you know there is a holding company, subsidiary company, minority interest. That means the holding company holds maybe 80% shares of the subsidiary company. So the remaining 20% is the shares which is not held by the holding company. That is simply called the minority interest. There is a date on which the consolidated balance sheet is prepared and the date on which the shares is acquired. Before that is called pre-acquisition period and after that it is called post-acquisition period. And shares of holding companies calculated in this way: shares held by holding company and the total number of shares of subsidiary company. Pre-acquisition profit and reserve is to be calculated, and next you have to calculate the goodwill and capital reserve. Next there are some special items like mutual ownings, like trade debtors and trade creditors. Mutual set off is required, bills receivable, bills payable, loans and advances. So mutual set off is required. This is one example that you will get. I've given some examples and that I'm not going to discuss. Now coming to this last part, that is accounting standard. In accounting standard, you have to learn what is IFRS. I'm giving you this is the principle based standards, international financial reporting standards, and all Indian accounting standards, that is the current IND-AS. It is just a carbon copy of IFRS. And applicability of accounting standards, that means companies whose shares are listed are going to be listed or having a net worth of 5 crore or more. That is the phase 1, 250 crores to 500 crores. That is phase 2. These companies have to prepare the financial statement as per the new accounting standard, that is IND-AS. And net worth definition is given, the framework on the basis of which the accounting standard is defined. And I've given IND-AS. What you have to learn is objective, scope, and definitions. Okay. Next, there is another standard which is included in our syllabus, that is property, plant, and equipment. From that, you have to again learn objective, scope, and definition. Definitions: depreciation, cost, fair value, carrying amount, impairment loss, recoverable amount, useful life, residual value. And the last accounting standard that we have to learn is EPS. Here also you have to learn the meaning, objective, scope, definition of ordinary share, potential ordinary share, dilution, anti-dilution, contingent share agreement, put options, etc. Measurement of EPS from the statement of profit and loss. You can see there is uh, basic EPS and diluted EPS, and I've given the, this is the main problem. You just go through the problem, then you will easily understand the meaning of basic EPS and diluted EPS. Okay, so with this, I'm ending my presentation. Thank you.
Thank you, sir.
Thank you.
Our principal madam just now informed us that she has another meeting to attend. That's why
Yes.
she left. Anyway, we
Okay.
extend our deep gratitude by conveying vote of thanks to our reputed speaker. And I thank Dr. Karmakar for sparing his precious time for us and gracing this student webinar with his presence. We all get enlightened with his valuable analysis.
Thank you, ma'am. Thank you. Thank
Yes,
you.
yes, and we also forward our mark of respect to our President of SS Jain President and Secretary of Governing Body of this college, for giving us the opportunity to conduct this webinar. And I would also like to express my thankfulness to our Principal Madam, our technical support team, other teachers, and our beloved students. So, with this, we are concluding today's session. And students, for you, there is an announcement. You will be provided with the link of a feedback form later, and whenever you get it, fill it up accordingly. It is about today's session. So thank you all once again.